A dozen people meet 8 times a year behind closed doors in Washington. One decision, one number, and your mortgage suddenly costs $178 more each month. The Federal Reserve controls inflation, sets the price of borrowing, and shapes the financial life of an entire nation. But how does a single rate decision actually travel through the economy and land in your wallet? The Federal Reserve sits at the center of American economic life, but its power comes with a clear legal mission. Congress has given the Fed what is known as the dual mandate, to keep prices stable and to aim for the highest level of employment the economy can sustain. Every policy decision, every rate change circles back to these two goals: steady prices and strong job markets. The responsibility for these decisions falls to a specific group, the Federal Open Market Committee, FOMC. This committee is made up of 12 voting members. 7 of them are the members of the Board of Governors, who are appointed by the President and confirmed by the Senate. These governors serve staggered 14-year terms, giving the board a layer of independence from political cycles. Alongside the governors sits the president of the Federal Reserve Bank of New York, who always has a vote. That is because the New York Fed handles most of the central bank's operations in financial markets. The remaining 4 votes rotate among the 11 other regional reserve bank presidents, ensuring that voices from across the country are heard. Each year, a different mix of regional bank presidents steps into a voting role, bringing fresh perspectives from places like Cleveland, Dallas, or San Francisco. At each scheduled meeting, 8 times a year, the FOMC reviews economic data, debates risks, and ultimately votes on policy. The chair of the Board of Governors leads these meetings, but every voting member's input counts. The committee's decisions are not made in isolation. They reflect a blend of national trends and local realities gathered from every corner of the United States. This structure is designed to balance expertise with representation. The FOMC is not a single person or a distant bureaucracy. It is a rotating panel of economists, bankers, and public servants, all tasked with steering the economy towards stable prices and full employment. Their votes decide the direction of interest rates and, by extension, influence the cost of borrowing, saving, and investing for millions of Americans. Inside the Federal Reserve, monetary policy moves from discussion to direct intervention. When the FOMC sets a target for short-term interest rates, the focus shifts to the mechanics that shape the flow of money through the banking system. The federal funds rate stands at the center. It is the rate banks charge each other for overnight loans of reserves, electronic balances held at the Fed. To actually influence it, the open market desk at the New York Fed buys or sells government securities. Buying treasury bonds credits banks' reserve accounts, increasing total reserves and making it easier for banks to lend to each other, which pushes the rate down. Selling securities drains reserves, making money tighter and nudging the rate up. Interest on reserves is another key tool. Since 2008, the Fed has paid banks interest on the reserves they hold. Adjusting this rate encourages banks either to keep reserves parked at the Fed or to lend more freely. It acts as a floor for the federal funds rate, and it gives policymakers added control. The discount window serves as a backup. Banks can borrow directly from the Fed, usually at a higher rate, providing a safety net during periods of stress, but it is rarely used in normal times. Reserve requirements. Once set the minimum reserves banks had to hold against deposits, acting as a constraint on lending. Recently, the Fed reduced this requirement to 0 for most banks, shifting reliance to other instruments. At the core lies the monetary base, reserves plus physical currency. When the Fed adds reserves, the base expands. Banks use these reserves to make loans, and every loan creates a matching deposit, moving money from the Fed's balance sheet into the wider economy. Yet lending is not limitless. Banks face capital rules and must find willing borrowers. Every tool, open market operations, interest on reserves, and the discount window alters the reserves in the system. These changes ripple through bank balance sheets, shaping how much money is available for lending, and ultimately influencing borrowing costs across the economy. A young couple sits at the kitchen table running numbers for their first home. With a $300,000 mortgage at a 6.5% fixed rate, their payment lands at $1,896 a month. But if the Fed raises its target rate by 4 percentage points, that mortgage rate can jump to 10.5%, and their payment leaps to $2,700 a month. That is $804 more every month, almost $10,000 extra each year, just for the same house. Suddenly, what felt affordable now strains their budget, pushing the dream of homeownership out of reach for many. Down the street, a small business owner considers a $50,000 loan to buy new equipment. With rates tied to the Fed's decisions, her 5-year loan at 5% means $943 a month. If rates rise to 9%, the payment climbs to $1,041 a month. Over 5 years, she will pay nearly $6,000 more in interest. That is money she cannot use to hire staff or invest in growth. For some businesses, higher rates mean shelving plans and holding off on new jobs. A family shopping for a car faces the same reality. On a $30,000 auto loan, a jump from 5.75% to 9.75% raises their monthly payment from $571 to $639. Even credit card balances feel the pinch. A $5,000 revolving balance at 10% annual percentage rate costs $504 in annual interest, but at 14% annual percentage rate, it is $696, a difference that adds up when budgets are tight. Not all the changes are bad news. A freelancer with $10,000 in a high-yield savings account sees annual interest climb from $250 to $650 as rates go up. But for most households, the extra savings income does not come close to covering the higher costs of borrowing. When the Fed moves its target rate, the effects ripple through every corner of daily life. Mortgage payments, business loans, car notes, and even the interest on a savings account all are shaped by decisions made in a conference room in Washington, D.C. For millions, those decisions determine how much is left in the bank at the end of the month and how far a paycheck really goes. In the late 1970s, the Federal Reserve faced a crisis that would test the limits of monetary policy. Inflation had soared into double digits, and prices were rising faster than wages. Paul Volcker, appointed Fed chair in 1979, responded with a series of rate hikes that pushed the federal funds rate near 20% by December 1980. Borrowing costs skyrocketed. Homebuyers saw mortgage rates climb above 16%, and businesses struggled to finance new projects. The pain was real. Recession followed and unemployment rose. Yet by 1982, inflation had fallen from 13.5% to just 3%. Volcker's approach proved that the Fed could crush inflation, but not without causing real hardship along the way. 3 decades later, the financial crisis of 2008 forced the Fed to confront a different kind of threat. This time, the danger was not runaway prices, but a collapse in lending and spending. Under Chair Ben Bernanke, the Fed's traditional tools were not enough. Interest rates were cut to nearly zero, but the economy kept stalling. In response, the Fed launched a massive program of quantitative easing, buying Treasury securities and mortgage-backed bonds to inject money directly into the financial system. The Fed's balance sheet ballooned from $860 billion in 2007 to $4.5 trillion by 2014. The goal was clear: keep credit flowing and prevent a deeper recession. While the strategy stabilized markets, it also showed that expanding the Fed's balance sheet could support the economy when rate cuts alone fell short. After the COVID-19 pandemic, the Fed faced a new test. In 2020, rates dropped close to zero to cushion the shock. But by early 2022, inflation returned with force, climbing well above the Fed's 2% target. Chair Jerome Powell and the Federal Open Market Committee responded with a rapid series of rate hikes, raising the federal funds rate from near zero to over 5% in less than 2 years. The pace was the fastest since the Volcker era. Mortgage rates doubled, credit card interest rose, and households felt the squeeze at the grocery store. These episodes reveal both the reach and the limits of the Fed's power. The tools are powerful, but every action comes with trade-offs. Sometimes slowing inflation, sometimes risking recession, and always shaping the cost of money for everyone. Right now, every shift in interest rates shapes the cost of daily living for millions. As inflation and uncertainty test household budgets, Federal Reserve decisions reach far beyond headlines. They reach your wallet. In a world of constant change, understanding this power is no longer optional. Thanks for watching.